Let's talk about disposing of plant assets. We've disposed of plant assets through our discussion when we exchange old assets for another asset we're interested in. Here we're going to look at a straight up sale of an asset. And in particular, we want to remember that at whatever point of time this is, we need to make sure depreciation is up to date. And if we're going to take this asset off the books, we need to account for that properly. Let's do this through an example in the handout. This one's BE 1014. Ottawa Corporation owns machinery that cost $20,000 when it purchased this on January 1, year 1. Depreciation has been recorded at a rate of $2,400 per year. And at the end of year 4, the balance in accumulated depreciation was $8,400. The machinery was sold on September year 5 for $10,500, and it asks us to make the appropriate journal entries. So first, we had recorded depreciation the first 4 years, and in year 5, we wound up selling this. So let's think about what the balance in accumulated depreciation should be at the time of sale. This is going to affect our accounting for this sale of the plant asset and any losses or gains that are included. So, depreciation so far, let's see, $20,000. So this was our cost, $20,000. And at the end of year 4, we had accumulated depreciation of $8,400. So at the end of year 4, our net book value or carrying value is going to be $11,600. So we made this sale, we sold this piece of equipment in year 5 on September 1st. That means we've used this piece of equipment for 8 months during year 5, and therefore we need to record depreciation related to those 8 months before we record the sale of the equipment. So the problem tells us that annual depreciation is $2,400. So if I want to think about this, what is 8 months worth of depreciation? There we go. I'll take that $2,400, multiply it by that fraction of the year, 8 months, and that comes to $1,600. So first, I'm going to take care of recording the depreciation. This is going to be depreciation expense, $1,600, credit accumulated depreciation, $1,600. Let's think about how this is going to impact our new book value. If we think about accumulated depreciation, at the beginning of year 5, we had a balance of $8,400. We just added 8 months worth, which was $1,600. So now our accumulated depreciation balance is $10,000. We've recorded that $1,600 worth of depreciation expense like we should have for year 5 in those 8 months. Now we're ready to record the sale of this equipment. So let's take this machine off the books. We originally paid $20,000 for it, and we have accumulated depreciation of $10,000. It says that we received $10,500 in cash for this piece of machinery. So we've got $20,500 in debits, $20,000 in credits, and we can see if the book value of this machine is $10,000, cost of 20 minus $10,000 accumulated depreciation, we're carrying it on our books right now for $10,000. We just sold it for $10,500. So this means we'll record a gain. How does that affect the income statement? It's just like revenue, it'll increase net income.